Good morning. It's 9 a.m. here in Hong Kong, in Beijing, and in Shanghai. Welcome to Bloomberg Markets China Open. I'm David Ingles with Yvonne.
Our top stories this morning. The pain continues in Asia after Wall Street saw its worst start to a year in decades, with bonds and stocks falling in tandem. The PBoC revealing it's injected nearly $50 billion worth of low-cost funds into policy banks, suggesting a ramp-up in support for the economy. And BYD becomes the new #1 in global EV sales, outselling Tesla in the fourth quarter, driven mainly by a lineup of cheaper models. Certainly Tesla getting dethroned, that's a big theme for us here in China markets here today, but we got to talk about this pullback that we're seeing across risk assets.
Yep. So we had, I think yesterday was a sort of bifurcation between Chinese equities, which we'll get to later. Didn't really get off to a good start to 2024. No. The rest of the region, though, did very well, right? So we went into this morning, markets like Australia were close to record highs, Kospi 19-month highs, but everything's coming back down altogether right now with the declines we had in Wall Street. In fact, let's have a look at where we are. A50 futures, 1.3% drop on the CSI 300 to start off, or to kick off 2024. We're steady on that. We're slightly lower right now in U.S. futures following, really. So there's the Apple story, there's the NASDAQ, there's this repricing, which we'll get to in a moment, in Fed Fund futures, for example. We talked about a couple of markets. Flip the boards, please. So you have Australia, which came into today 5 points from all-time highs. That's pulling back. You have a tech-heavy benchmark like the Kospi, because of perhaps declines overnight, that's getting whacked as well, 1.8%. It's worth mentioning, too, the Kospi has done very, very well over the last 2 months or so, hit a 19-month high. That's past tense now, obviously. FX markets, you had a very big pop in the dollar overnight, depending on which benchmark you look at. The Bloomberg dollar gauge, biggest gain since mid-March of last year. The bond markets declines along with equity markets, so those two asset classes are moving in tandem right now. Just keep in mind, Japan is still shut, so no cash treasuries today, although you are getting, I think you're going to see your U.S. futures right now, treasury futures 2s and 10s, and also your 10s in Australia and New Zealand. Yields are pushing higher, as you can see there. And very, very quickly, a glance at commodity markets and oil, iron ore on your screens right now, as we're higher slightly on oil, but that's been on a, 3-4 day decline on global benchmark prices.
Yeah, from more, let's bring in Bloomberg's MLI strategist, Mark Cranfield. And Mark, we thought we could kick off 2024 kind of where we left off the last 3 months, but not quite. What do you make of this reversal?
Not a huge amount, really. I think there's a little bit of nervousness ahead of the FOMC minutes. I think once we get those out the way, I think people will calm down again. I think some people are concerned they'll see a pushback in those minutes to suggest that the Fed weren't really as dovish as they sounded in December, but I think that's not really the case. I think once we get past it, people will realize, yes, the Fed really was discussing lower rates, and that's the game plan. Importantly, the makeup of the Federal Reserve, as Bloomberg Economics were pointing out, for this year, there are less hawks on the FOMC committee. It's gone much more centrist. Now, that means they're going to be much more influenced by the data that immediately comes ahead. Now, we had that crucial PCE core inflation print with a 1 handle in December. That's what Jerome Powell probably already knew about when he sounded dovish at the FOMC minute. We're going to have a couple more of those in the next month. So at the end of January, we get another one. If it prints something like that again, these new members of the FOMC voting committee will have all the ammunition they need to do that first rate cut in March. So it's still very much on the table. So most global markets will be able to relook at those Fed minutes and see that, yes, they really were as dovish as they sound. Of course, the exception might be Greater China. What's going on in Hong Kong and China really is a different story. You probably want to talk about that as well.
Well, yeah. Why don't you, Mark? Go ahead.
I mean, there's really, it's very hard to look past the immediately gloomy situation you have there. And most concerning is the fact that investors outside the region are not putting their money back into Hong Kong and China. So yesterday, Hong Kong stocks declined, and yet there was a net inflow on the stock connects from the China side. Now, that means that even with buying from the mainland, stocks still couldn't rally. So that means that there's too much selling still going on by foreigners. You might have thought that they'd done enough last year, but they're still selling. We also had a report that mutual fund outflows in December for Greater China equities were the worst in several years, maybe the worst on record. So even though you may have thought everything is priced in, apparently not. They're still frustrated that the central bank in China is not coming forward with another easing quickly enough. They keep on putting these media reports out saying that they're about to do more to help the economy. Well, get on with it. Foreign investors are losing patience and they need to see some action quickly.
Yeah, and not just in the newspaper, Mark. I was looking at some of the stats from our Inside China column. It's quite astounding. I think the CSI 300 is down, I think, 3 straight years. It's the first 3-year run of that sort since the index came out in 2002. The Hang Seng is 4 years running down. That's the first time in, 50 years on the Hang Seng Index. Is there anything, Mark, over the next 12 months that might indicate that changes?
We really need to see some sustained, solid data coming out on the Chinese economy. We need to see you've got the PMIs that came out last week, again, were well below 50, not looking good. We need to see a consistent flow of good data coming out on the Chinese economy. We need not just to see positive sound bites. We need to see the China authorities putting their money directly into places that support, whether it's property, whether it's to help consumers do more, wherever it is, they need to be the action. You were just talking in the headlines there about $50 billion going into these special project banks. It should have been $500 billion. The market needs to be overwhelmed. They need to see really something substantial to make you sit up and say, that's a huge amount of money. We must go back into China stocks. This gradual small amounts going in, that's not really going to help the situation. Okay,
well, Mark, thank you. Mark Cranfield there. Happy New Year. Out of our MLive team, of course.
Happy New Year.
In fact, just on that very story that Mark just pointing out, more details in that, if it's relevant, let's go with Mark here. So the PBoC said it did inject $50 billion or nearly $50 billion worth of low-cost funds into policy-oriented banks last month. It suggests that the central bank may be ramping up its financing for housing and also infrastructure projects to boost or support the economy. The outstanding amount of the PBoC's lending program to policy banks climbed to $456 billion US. That's as of the end of December. Net injection was the largest such increase via this specific tool going back to November of 2022.
Yep, it wasn't enough for Mark Cranfield. Let's see if it's enough for Ding Shuang, Chief Greater China and North Asia economist at Stand Chart Bank. Yeah, I mean, it's a controversial tool. First of all, how important is it that they're using it? And is $50 billion still not enough?
Yeah, partly this is a way for the central bank to inject the liquidity, to replenish the liquidity by expanding its balance sheet, increasing lending to the financial institutions. But on the other hand, this is part of the structural policy toolkit. So this, I believe, is intended for the property sector, most likely the renovation of the so-called urban village. So this is also a sign that the government is becoming increasingly forceful in rolling out policies to support the sector due to the drag of the sector on the economy.
Why haven't we seen sort of a one-time, big bang? And I'm wondering, is that a reflection of their inability, the policy friction, for example, or is that preference?
I think it reflected intention. If we read the Central Economic Work Conference very carefully, I see no appetite for strong stimulus. I think the priority is still the so-called high-quality growth, featuring innovation, high-end manufacturing, green and inclusive development. For example, if we have 1 trillion, for example, a PSL, actually it goes counter to those long-term objectives because actually it will increase the supply of the social housing. And the property market already very weak. How it would help in terms of boosting growth sustainably.
The fact that they're deploying this tool now, does that reduce the chances of other forms of stimulus, like a triple R cut? Should we rule that out now?
Not really. I think even though there is no appetite for strong stimulus, I think the leaders, the top leadership still want to consolidate and strengthen the recovery momentum. And they called for an intensification of the macro policy adjustment. So we think the policy will still have easing bias, not a stimulus. On monetary policy side, we think there will be a medium-term lending facility rate cut in this quarter and as early as this month, given the recent cut of deposit rate by major commercial bank. That's a kind of precursor to a rate cut. And also, we expect RRR cut in the second quarter. And again, I think people will increasingly focus on the balance sheet of the central bank. The central bank balance sheet expanded quite significantly last year, faster than the nominal GDP. And with the RRR already at a very low level, I think they will increasingly rely on the balance sheet expansion.
Your forecasts for 2024 and upside and downside risk to that view?
Yeah, 2023, we estimate 5.4%, a little bit higher than the consensus, but that is mostly because of the low base, favorable base. So the performance is still quite mediocre for 2023. We call it an incomplete recovery. For 2024, I expect a year of further normalization. We forecast 4.8%. Annual growth. That would not be an easy task because the favorable base effect is no longer there. It will require policy support. The downside risk still from the property sector. We expect less contraction of the sector in our forecast, and we also expect a quite supportive policy as well. And the downside risk is if the contraction remain at the current pace, then it's a downside risk. And also, if there is a lack of confidence on the part of the business and the household sector, that will hold back the consumption.
You mentioned normalizing consumption as maybe a way, what would that look like? I mean, can consumption get back to pre-COVID levels, you think?
Yes, and actually grow above the pre-COVID level. And we see some signs of willingness for the household to draw on their excess savings. The excess deposit, savings deposit already at 110% of GDP. That is way above a normal trend. And but in the third quarter, we already see the per capita spending exceed per capita income. So that's an indication that apart from improving employment and income prospect, drawing on the excess savings could be another way to normalize the consumption.
The preference not to unleash big stimulus is perhaps understandable to your point. There's no indication from the work report they want to do that. So I want to get to how would you describe the employment situation? Because in many ways it comes down to stable employment. And what are you seeing right now?
If we just look at the overall unemployment rate, it is currently at around 5%. So that is exactly the pre-COVID level of unemployment rate. But for the youth, we all know that even though I think no data has been released, I think since the middle of the year, the situation is still quite challenging. So there is a structural problem in the market. Another data I look at is the weekly working hour. So that has been above 48 hours per worker for many months. So that means if it's an 8-hour work day, basically everyone works for 6 days. So in general, it's not, I think there is a structural problem, but it's not as bad as I think some people fear.
Okay, that's interesting.
That's fair.
To look at different metrics. What about the risk of deflation and staying in this sort of mindset? Do you think that risk is heightened now, or do you think less so?
The risk is still there. For example, even with our estimate of 5.4% growth for last year, at the end of the year, our estimates show the economic activity is still 2 to 3 percentage points below the trend level. That means there is a negative output gap that would cause deflationary pressure. And for 2023, for example, if we look at the broad gauge of inflation, that is a GDP deflator, we estimated at negative 0.8%. which means nominal GDP growth will be lower than real GDP growth in 2023. So as a result of that, we think the government may set a growth target at around, keep the growth target at around 5% for this year, partly to narrow the negative output gap and to prevent the deflation expectation from becoming entrenched.
From worsening too. Happy New Year.
Happy New Year.
Hope you have a fabulous one coming up. Ding Shuang there, Chief Greater China and North Asia Economist at Standard Chartered Bank. Right, so we're coming off the worst or the biggest decline in onshore Chinese yuan in a couple of months here, and we're coming in today with the strongest fixing versus estimate since December out of the PBoC, and as you can see, we are weaker on offshore. The reference rate 710.02 against the U.S.
Yeah, so 465 pips upside there to what the consensus was. So certainly, I mean, reflecting also a little bit about that dollar rebound that we saw overnight as well, certainly given what we've been seeing with the repricing of Fed bets and all that when it comes to cuts and all. So certainly, PBoC taking some action here today. Still ahead as we count down to the China Open. BYD taking the crown from Tesla as the world's top seller of all EVs, despite Elon Musk's company beating fourth quarter delivery estimates. We have details on that in a moment. Plus, we'll be live at Japan's Haneda Airport as crash investigators search for answers following a runaway collision between two planes in Tokyo. All right, so, you know, obviously we hit a milestone, right, with BYD overnight. So Tesla confirming their quarterly numbers, and basically we've seen, at least for the fourth quarter, BYD dethroning Tesla in terms of being the world's largest seller of EVs. But you look at the market cap, you've been looking at this, right? Other metrics are really how to compare the two. And there's still other sides of the story that we have to talk about as well.
Yeah, I mean, it's still maybe a function. It's a much bigger company still. You know, the market where BYD is listed hasn't done well. We all know, of course, what the NASDAQ's done. And, you know, it's also about pricing of the vehicles, how much they sell against margins and all these other things as well, right? So at least on one metric, though, to your point, BYD is now top of the world for that specific quarter. Danny Lee is with us right now to talk about that story, Asia Transport Reporter. Yeah, so finally.
Yeah, finally we saw that change happen symbolically, that BYD is bigger than Tesla on EV sales for the first time on a quarterly basis. Then you look to 2024, can they match that on an annual basis? So that's going to be the next big kind of leg up. But obviously, as you started the show with the intro, you've got BYD, which lags in market cap, in profitability, in revenue numbers, and also, you know, in average car, you know, the generation of cash generated from each car sold.
Per unit, yeah.
Yeah, so there is still a big gulf there, but Bernstein put out a note towards the end of last year. They expect that revenue gap to close considerably, and BYD pushing for even more expensive cars in its lineup is well on its way to do that.
And it really changes the dynamics of this industry, right? That it's not about legacy anymore. It's really about who can innovate the fastest.
And also, when you think about the fact that BYD and Tesla combined have produced, well, obviously BYD has EVs and hybrids, like almost 5 million units between them produced. So it's still a wide number, but especially as you can innovate and as you can be in the EV sector and have a strategy, which is why you've seen the legacy automakers such as your Toyotas and your Volkswagens coming in, lagging these two. But as we've seen with Tesla, investors still are happy that they beat on their annual targets. But, you know, even for Elon Musk, they expected to potentially sell up to 2 million, but they haven't quite done that last year.
Okay, so outlook for this year on both separately, both companies?
Well, Tesla has the Cybertruck that's going to be continuing to ramp up with its production and sales. They didn't quite give analysts any kind of meat on how much they sold or produced in the final quarter of the year. But for BYD, that real push into overseas markets, they've already done 60 markets and territories in 2 years, and especially with the competition heating up in China, they really need to be looking at overseas markets to really ramp up more of their sales. 10% of their exports, overall sales, 10% make 10% of the overall sales come from exports at the moment. So if they can do more and potentially challenge Tesla more directly because it's not in the US market, for example, then we'll probably see more of a bit of a balance between the two brought to bear.
Danny, great to have you back. Danny Lee, their Asia transport reporter, joining us on the latest when it comes to, of course, this rivalry. Let's get to the other corporate stories that we're tracking for you. Airbus managed to beat its annual delivery target in 2023 as the playmaker ramped up output in December. According to Aviation Flights, which tracks aircraft handovers, the firm likely delivered 733 jets to customers last year. One source also said Airbus exceeded its goal of 720 deliveries. The company is due to reveal its official tally later this month. Fidelity estimates the social media platform X, formerly known as Twitter, is now worth less than a third of the $44 billion Elon Musk paid for it back in October 2022. It's the latest in a series of markdowns by Fidelity as X struggles to hold on to advertisers and is weighed down by $13 billion in debt. Meanwhile, users say news headlines have reappeared alongside links shared on the site, a quiet reversal from a change Musk himself implemented last year. We got plenty more ahead, including your agenda for today in terms of these markets. Futures are flat here this morning, and we are seeing 715.42 for dollar China. This is Bloomberg.
Okay, welcome back. And it's Wednesday, right? Yep, it's Wednesday. So it's a new year. It's an old story still. The declines across equity markets in Greater China yesterday, that is what we're seeing. In fact, right now we're down 0.25%. Hang Seng looks to open about 1% lower. 16,620 is the level I'm looking at here on my screen. So they have declined still.
Yeah, we've turned the calendar page, as we all say, but, you know, nothing's changed.
No, might as well be what happened last week.
All right, you take a look in terms of analyst actions today. There's one on the energy space. The Costco Energy H shares reinstated buy at HSBC with a price target of $10.60. Citi coming out with a call when it comes to Hong Kong developers, basically worried a little bit about higher rates and how's that going to impact when it comes to the property market. So New World as well as Wharf both cut to sell there. Yeah,
New World's been in the news really of late because of the debt burden there. I mean, maybe partly to the point there of the Hong Kong property stories, falling HIBOR rates, which might prove a bit of a reprieve here for, I guess, buyers. Rongsheng Petrochemical, that's interesting. So this company actually came out with a deal with Aramco. We'll talk more about that, but various things to watch, of course, ahead of the open here.
Yep, and of course, we're watching tech space, given just the pullback in risk assets. So we're already seeing the likes of Tencent and NetEase down some 1% for NetEase. Also, EVs, just given what we've been seeing when it comes to BYD and Tesla as well. NIO down some 3.5%. The open is next.
Good morning. Welcome back to shows. The open is 40 seconds away. Investors are waking up to likely losses. And if you're in Hong Kong, you're likely also waking up to maybe something in the air. And as you can see from our live shot there on your screens, personally, feels like someone's playing Mario Kart in my nostrils. But
that's an image.
That's the only way I can describe this, frankly.
It's a hangover, right? Yeah. You know,
it's a right side only
countdown, too. And then it takes a couple days to really recover, right? And that's how markets are feeling here after 3 months of really broad gains, except for China, which that story really hasn't changed. And I think those PMI numbers really did suggest that maybe things are still looking weak in December. Although Caixin was conflicting, right? But then,
very good number.
Most economists say, look, you gotta kind of push that aside. That's not really showing, and that's not going to deter the PBoC from doing stimulus this year. So there you go. 1% losses for the Hang Seng. It's really the tech side of things. So, given what we saw with the NASDAQ, the Mag 7, the concerns on Apple and that downgrade by Barclays, that certainly is roiling the tech sector in particular. We're down some 2% on that gauge or so. CSI 300, we talked about, it was the worst start since 2019 for Chinese stocks, and looks like we are furthering those declines about a third of 1%. And MSCI China also down about 0.9%. We did see the strongest fix from the PBoC since December. So that dollar rebound is certainly being reflected here. Maybe the PBoC trying to stabilize the currency in some ways. Iron ore, at least, is still doing well. That's probably the standout there. We're up about 3%. The flip side, Shanghai crude is down about 3% as well. And we're watching very closely, sector by sector, how this all plays out. So EVs is certainly one we're watching out for. Gaming stocks, that's a one. Local media has been also talking about the prospect of stimulus, right? They may continue cutting interest rates in RRR in 2024. You have the likes of ANZ, Raymond Yuan, saying as early as this month, we could be seeing that just given how weak those PMI numbers were. And you look at what we're seeing in terms of sectors. So it's mostly red here today. We're flat when it comes to financials in Macau and real estate. So that's it. But the rest is seeing quite a bit of downside. You look at what we really are tracking, the EV side of things, that might be where a lot of that bloodshed is. NIO's down some 4%. So the ADRs definitely fell on the back of this pullback, but also Tesla falling behind BYD in quarterly sales. So that's really impacting a little bit. But BYD also lower despite that milestone. And we're also watching these gaming stocks. So Reuters reporting about this official being removed, the publishing official, after what happened in that rout in gaming shares. So, it should actually spark positivity in some ways, right? That given that maybe policymakers are a bit concerned about what happened to that market, but still, we're being overshadowed by overall broad risk off.
Yeah, I mean, the intention maybe there from the report is maybe they're clarifying that there is no crackdown that's taking place again. But I mean, markets will listen to what they listen to, right? So if it's bad news, higher yields, then they fall.
Yeah.
If it's in the economy, then it falls. If it's good news, they look at higher yields.
And then there was the
and
Apple
then
suppliers who forgot to mention, right? That downgrade sent the stock falling in Apple. So suppliers certainly very much in focus.
Yeah, the iPhone 15 isn't
weak as they're thinking.
They're checks. Okay, well, it's that time of the year when we look at the outlook for this year and some of the projections that will probably be wrong, but of course things change, right? Anyway, here's the outlook for many people that we spoke to last year on what they think Chinese markets will look like this year. Have a listen.
For us, our preference is still to find global conglomerates with exposure to China rather than investing directly into that Chinese equity market.
Based on what we see, our allocation is likely to go higher. It was higher this year than it was last year, and we think that will be the case next year as well. China is a good market for relative outperformance. It is also a good market for absolute performance, not just this year, but it has been for years, and we think it will continue to be that way.
So we expect more reserve rate cuts next year and some more policy easing, but not bazooka-style stimulus. Right now, China equity market is priced for a slowdown, growth below 5%. So expectations are low, positioning is very low. So we would be gradual buyers as the property market bottoms into next year.
China has got some good ideas, but the visibility is missing, and as a result, a lot of investors don't want to stay, don't want to commit to China on a longer-term basis, preferring kind of shorter-term trades, tactical trades.
Let's get another view. Fresh one from Eva Lee joins us for our first chat this year. She's head of Greater China Equities at UBS Global Wealth Management Chief Investment Office. Happy New Year.
Happy New Year.
New year? New look for the market?
Wow. I think it's a bit of a continuation of the issue that we talked about last time I was here. No bazooka policy support. We start to see, PSL. Today, this morning, we have this PSL. That's important for housing market. But we expect more triple R cut. But the consistency of policy, I think we still need it. Like online gaming, that happened when I was on holiday. I was shocked.
Me too.
Yeah, that got me looking at my screens too.
Stop you from your skis, like, what?
Even though it's still in consultation. But I think these type of news release really confuse market. Like, we need support for the private enterprise. They already have struggled a bit, in this sort of weaker economy. So hopefully, I think by the time the actual policy is released on January 22nd related to online gaming, we potentially see a positive surprise. Looks like it's shaping there. So I think overall, it's policy consistency, support for housing market, sentiment return, so that eventually the enterprise will increase investment, consumer will increase their spending, and of course, the employment market will be better. I think that is all needed to bring people back to the Chinese equity market.
You've covered China property for a very long time. You've seen what PSL can do, right? Back in 2014 and all that. I'm just wondering, in the whole arsenal of tools, how powerful is it in really stimulating the housing market?
Well, first, it depends on scale, right?
Yeah, I mean, 50 billion, as we talked about, is quite minuscule.
Yeah, second, it's because last downturn, what they have done is they actually give people actual subsidy to buy, the vacant homes, vacant units. Remember that time we have so much oversupplied in the lower tier cities. So that is powerful because actual money really go into the system quickly and then snap these vacant units out of the system. Now they are talking about they give subsidy but not necessary actual money, and they are more selective. They are talking about urban redevelopment. They are talking about building up all the government's rental housing, affordable housing, like public rental units in Hong Kong. So this is more, we cannot say it's on an equal scale as the last downturn. I mean, talking about the benefit or the support. But definitely better than nothing, right? Because the sales volume was hitting the new low. December volume's actually worse than November.
Right.
So I think we need, any marginal, sort of increment, it's important for us.
Okay, well, if it was up to you, what do they need to do? If there was one measure, what would it be?
I think it's still housing market.
Okay, but what? What exactly? What do they need to do to the housing market? What's lacking?
I think,
if money wasn't an issue.
Money wasn't an issue. Wow. They should repeat what they have done, that even though I know that they won't, which is, giving people extra subsidies to buy in the market.
Okay.
Yeah.
What is the strategy then for this year? If none of that still transpires, right? I mean, is there still reason to raise your exposure in China this year?
We actually have done a very detailed analysis. We called it China 3.0. So we're talking about slower growth. So how we position in a slow growth environment. And we actually pick 3 themes. We talk about value proposition. Like people do not have as much money to spend, but they still spend. So value for money, which, no matter e-commerce, consumer sector, we do have these names that do well. Okay, second, global presence. Obviously that auto company that you mentioned today, that's one of the global presence. Not only that, healthcare, they do have global presence. I know that, in the developed markets, they do have all these restrictions, exports, tariff and all that. But there are companies, somehow they do have the pricing power, the cost, sort of management. They're able to do well in the global market. Lastly, tech supply chain. I know that you think about, you don't have the chips, the advanced chips in the US is restricted, how can you benefit? But the mature chips actually, a lot of it is manufactured in China, and they're able to support most of the consumer electronics, like your vacuum cleaner. You do need chips, that's sort of basic. Auto, you need chips. These are actually self-manufactured in China, and I think there is more government support. So these 3 themes, I think, will do well under the China 3.0. And this is more beyond, like 2024 and beyond type of positioning.
So it seems that the index won't do well this year, although there are big parts of this equity market that can do very, very well. What's sentiment like right now among your clients as a starting point going into this year to take advantage of these 3, for example?
Well, I think for my investor, some of them probably still hold on, to the e-commerce names, which they were a lot lower than their cost. Right? Okay.
Yeah. Some of them losses.
Some of them we actually encourage them to rotate because they are names that do well, value proposition they do well, but some of them will continue to underperform. So it all really depends on rotating what's your existing stale inventory and position into the ones that will do well.
Okay.
And pockets of it, as I said, the 3 pockets that will outperform, and it's not just this year but beyond.
I was going to get to the geopolitics, or even just elections. I mean, it's a big election year. We have Taiwan elections next week. You have the U.S. election to wrap up the year. I mean, everyone's talking about Trump 2.0. How disruptive do you think is that going to be if in fact it transpires for Chinese markets?
I think at the moment, mainly noises.
Okay.
But we all understand that Trump actually focused a lot on economy. Very pragmatic person. I'm not saying that they will change the stance onto China. But I think at the moment, if he is in power, I sort of see that, he will sort of care about, the economy, and hopefully China can play a role on that. But so far, the geopolitical tension, the impact, the export, the chip and everything, I think will still be there. But noises definitely will create volatility for the market, particularly when we are moving closer to the U.S. election.
Eva, great to have you back. Eva Lee, UBS Global Wealth Management. Happy New Year. Some other stories we're tracking in China today. China's military is emphasizing its intent to crack down in corruption this year after a series of abrupt personnel changes in 2023. The People's Liberation Army Daily mentioned corruption 3 times in its January 1st editorial, the most since President Xi Jinping began his crusade against graft in 2012. Beijing replaced its defense minister and 2 generals last year without explanation. The Thai Prime Minister Srettha Thavisin says that Thailand and China have agreed on a deal to scrap visa requirements for travelers, a boost for the post-pandemic recovery in tourism. Chinese visitors will be exempted from requiring visas after the current temporary scheme ends in March. China will also grant Thai tourists the same permanent privilege. China is front-loading its oil import quotas for 2024, a move that's expected to help refiners better map out their production for the year. Data from consultancy JLC shows Beijing issues quotas for 179 million tons of crude. The total for 2024 is just slightly below what was awarded last year. China's big state-owned refiners are not subject to import limits.
Right, just ahead on shows, and it's just gone past 10:30 in the morning. In Japan, and you're looking at live pics on the left side of your screens there of the city of Suzu in the Ishikawa prefecture in Japan, of course, and the country is reeling from its second disaster in 2 days, an airport collision, plus, of course, the earthquake earlier in the week. An update on both stories next. This is Bloomberg.
Crash investigators in Japan are searching for answers after the country's second tragedy in 2 days. A runway collision, between 2 planes in Tokyo killed 5 people who were setting out on a relief mission to the country's earthquake zone. Now, joining us now from Tokyo is Bloomberg's Kurumi Mori and Erika Yokoyama. Kurumi, you are at the Haneda airport where this disaster happened. Just give us the latest.
That's right. Just a terrible, terrible start to 2024 in Japan. I'm standing here on the 5th floor of Haneda Airport at Terminal 2. Behind me is the runway where the actual collision happened. We saw that there was an explosion of some kind where a Coast Guard plane that was set to go to Niigata area, the earthquake-stricken area, collided with a Japan Airlines flight, JL 516. What you're seeing now is the remains of the Japan Airlines plane. I mean, you're not seeing much because it was a huge fire that took more than 5 hours, 100 fire trucks and a DMAT team coming here on site to try and extinguish the flames. But again, a huge explosion, a huge fire. We had a total of 379 passengers on board this flight. Thankfully, they escaped. They successfully got out through emergency slides in the front of the plane. Unfortunately, on the other end was that Coast Guard plane that was set to leave Haneda Airport, headed for Niigata Airport. That plane, we saw the big explosion. Presumably, we think that it was an immediate collision, and they have confirmed that 5 crew members have died. There's 1 surviving crew member who has regained consciousness. He was the captain of the crew. We're waiting for more answers, but the investigations are ongoing. Here on the ground, we are seeing a lot of investigators, officials surrounding both planes, both debris, I guess, is whatever is remaining of the plane, and just trying to find the main cause of this accident.
Yeah, Kurumi, I was going to get to that. David here, by the way. What do we know from very early investigations into what happened?
Yeah, David, so officials keep urging us that no conclusions have been made. What we do know are two things. The Japan Airlines plane did get clearance to land here at Haneda Airport on this runway. They got clearance from air traffic control that they could land, so they had that permission. The other part that we do know is that the Coast Guard plane also got some sort of permission to proceed to a certain point on the tarmac, on the runway. We don't know exactly, we haven't gotten clarity on exactly where that is, but early indications are pointing to signs of potential miscommunication between the cockpits and air traffic control. So we're thinking maybe that could be one way that we could figure out the cause. But again, investigations are underway. Officials keep urging us that nothing has been confirmed.
And we're still trying to continuing this story of this, this earthquake and the extent of this damage, Erica. Can you tell us the latest on what's going on in terms of rescue efforts?
Sure. The latest death toll rose to 62, according to the local media. And the numbers, including those with the severe injuries, are likely to increase because the rescue works are still underway under a cold and rainy weather. More than 30,000 people are at the evacuation centers. The most serious things they cited is a situation that quite a few people don't have any access to water, making it difficult for them to maintain sanitary situation and hydrations without clean water. And also an aftershock are continuing. Nearly 500 aftershock have hit the area since the first quake on the New Year's Day, and with some of them actually was as large as magnitude 5.
Wow.
Erica, do you see any signs of recovery at this point?
The situation has been really difficult and tough, but I also see a little gradual sign of recovery. For instance, in transportation, bullet train services connecting the major cities in the area resumed their operations, and some of the highway closures also lifted as well. But still, many things are uncertain, especially for the company. For instance, some major companies have factories, production site there, including Toshiba's chip factory. And spokespeople already told us that they're still assessing the situations, and the area hit by earthquakes are actually home to many local small and mid-sized enterprises, and which sustain a local economy, which is another concern from going ahead.
Erica, just very quickly as a final question, any update from the government so far on this?
For government, it's really a difficult situation as well, because the Japan Airlines and Coast Guards and airplane crash added their urgent tasks, and the government is set to hold a series of task force meeting today to deal with both an earthquakes and incident at the Haneda Airport, and we will hear more updates after this meeting is done.
Our team there in Japan, Kurumi Mori at the airport, and Erica Yokoyama, of course, joining us there, also out of Tokyo. Just a market update. So just two things at this point in time. You have the tech-heavy benchmark. You have Korea, you have Taiwan, you have the HS Tech Index. As you can see, really feeling the losses right now, following this pushing up in bond yields overnight. So these sorts of securities will tend to get hit when that happens. NASDAQ, of course, fell substantially overnight. The other story, and you're looking at a specific price on the Philippine composite, that's as of the last trade. We understand right now, breaking news, that the Philippine Stock Exchange says trading is halted. We don't know why. The only statement so far coming out is they say, or they're asking, to kindly stand by for further announcements on developments there. Plenty more ahead. This is Bloomberg. Okay, so we're looking at, well, diverging moves, unsurprising. This is fairly common anyway. Hang Seng is just coming off lows of the day. just down about 0.9%. We're seeing a minor reversal on short, 0.1% to the upside on the CSI 300, which fell 1.3%, of course, on Tuesday. A couple of stocks that we're tracking. China Fortune Land, some of the bondholders receiving only a partial payment, so this is a credit, this is a high-yield story, 1.2% on the stock itself, and we're also tracking, of course, BYD amidst that sort of changing of the guard for that specific quarter. The world's biggest EV producer now, taking the place of Tesla.
Originally, the whole EV space was kind of red. Now, at least BYD is slightly above water, if not flat. But NIO, take a look at that. That's down some 4%. And we're watching, of course, the gaming stocks in particular, given what we've been seeing. I think it was Reuters, SEMP reporting that publishing official has been removed after the turmoil that we saw in those gaming stocks. Tencent is recovering just a little bit here. We're 0.5% to the downside. And we're watching one thing around about 2 hours from now.
Yeah, this whole repricing of how much the Fed cuts this year has really benefited Hong Kong, I guess, relatively speaking, which we import monetary policy from the FMOC and the Fed. So HIBOR has actually been declining of late, and in fact, yesterday was the biggest decline, third steepest decline in 12 months. We're looking at Jakarta, of course, which comes online in the next hour. That market hit a record high on Tuesday. Plenty more ahead. This is Bloomberg.